Last year, 13.6 million international travelers cleared customs at Changi Airport, matching the population of entire European nations. Headlines splashed these glamorous figures across global financial networks as proof of an absolute economic rebound. Yet beneath the neon glare of Orchard Road, cash registers tell a contradictory story. Retail revenue did not follow the upward trajectory of tourist arrivals. It decoupled entirely. This commercial heart, which historically injected up to 2% of total gross domestic product directly into Singapore's economy, is emitting a low-frequency warning. Prestigious flagship stores are quietly dismantling their displays. Hallways designed to handle tens of thousands of footsteps per hour now echo with silence. This is not a temporary dip in a business cycle. It is the visible fracture of an urban economic engine engineered specifically never to fail. To understand how a failure-proof system begins to crack, one must analyze the architecture of its foundation. Singapore did not build shopping malls to merely sell consumer goods. It deployed them as highly optimized vertical land use instruments. In a territory spanning just over 700 square kilometers, land operates as a financial asset more valuable than bullion. The state tightly integrated retail hubs with mass rapid transit stations, forcing human traffic to flow directly through commercial corridors. For decades, this symbiotic loop functioned flawlessly. The physical structure of the city guaranteed customers, and customers guaranteed rent. The system reached its zenith through the introduction of real estate investment trusts, or REITs. These institutional vehicles transformed brick-and-mortar properties into securitized financial products, demanding relentless quarterly growth in yield per square foot. The entry of Wall Street-style metrics altered the genetic code of the retail ecosystem. Every square meter of a shopping complex had to justify its existence against a spreadsheet. If an open community area, a local clothing boutique, or a family-run eatery could not generate the same financial velocity as an international luxury conglomerate, the system flagged it for elimination. This optimization drive gave birth to hyper-polished, frictionless megacomplexes like Ion Orchard and Paragon. They utilized bright, open layouts flooded with artificial light, designed like seductive labyrinths to maximize consumer dwell time. The strategy worked until it ran into a physical limit: the exhaustion of the consumer and the rise of digital infrastructure. By 2026, the traditional transaction moved to screens, leaving massive concrete sanctuaries holding liabilities instead of assets. The first major casualty of this financialized purge occurred in the West. J-Cube was once the Jurong Entertainment Center, a suburban anchor that housed the country's only Olympic-sized ice rink. Geographically, its position mirrored the busiest transit intersections of Chicago or New York, sitting directly adjacent to a primary MRT interchange. It functioned as a central community node for Western Singapore, converting foot traffic into generational memory. But nostalgia cannot service capital allocations. When nearby institutional giants Westgate and Gem emerged with sleek aesthetics, J-Cube's late 1990s layout suddenly looked inefficient to institutional investors. The metrics dictated that an ice rink requires massive energy inputs while returning low rental yields per square meter. In August 2023, the operators wiped the slate clean. They demolished the structure to make way for Jadon, a high-density, ultra-luxury residential tower. The market decided that a space for community laughter was a luxury an optimized economy could no longer afford, while institutional operators can easily flatten a corporate-owned mall. The system encounters a different structural wall inside strata-titled properties. In these older developments, ownership is not centralized under a single REIT. Instead, it is fragmented among hundreds of individual retail units. Tanglin Shopping Center, a 1970s concrete maze located on the periphery of the luxury district, stands as an archaeological relic of this era. Its suffocating low ceilings and outdated electrical systems look obsolete next to a modern glass and steel flagship. Because ownership is fractured, coordinating an upgrade is nearly impossible. If the central air conditioning fails, one faction of owners refuses to pay to protect their margins, while another demands a complete overhaul. The result is structural paralysis. When performance dropped below the cost of capital, premium brands packed up and left, converting the mall into a dead zone of empty corridors. To break this paralysis, the market created a legal liquidation mechanism known as the en bloc, or collective sale. When a supermajority of owners agrees, they sell the entire property to a master developer, extinguishing decades of small business history in a single transaction. The successful multi-million-dollar sale of Tanglin Shopping Center was not an effort to revive a heritage commercial space. It was a targeted land bank acquisition. The investors did not purchase the retail business. They purchased the subterranean rights and the vertical space to erect Grade A office towers or elite condominiums. In a high-cost environment, holding an underperforming mall is equivalent to parking a vintage vehicle in a premium garage while paying compounding maintenance fees. The eradication of these strata-titled buildings has become an unavoidable policy trend to protect the financial velocity of Orchard Road. This brings the entire Singapore retail model to its true structural turning point. The system was designed on the absolute certainty that human traffic could be indefinitely converted into retail revenue through physical proximity. But as 2026 begins, the infrastructure of convenience has transformed. The consumer no longer tolerates vertical or spatial friction. The smaller, fragmented shopping centers that once served localized neighborhoods are losing their anchor tenants. The large supermarkets and cinemas that act as gravitational magnets for human traffic. Without these anchors, the architectural flows fail completely. The system is entering a feedback loop where older properties cannot generate the revenue required to upgrade, and their lack of upgrades drives foot traffic to zero. The mechanisms that once guaranteed wealth, centralized planning, hyper-efficiency, and relentless financialization, are now accelerating the obsolescence of the very spaces they built. The cracks on Orchard Road are no longer surface deep. The foundation itself has begun to shift. The systemic breakdown accelerates through a specific mathematical divergence. Between 2021 and 2026, prime retail rents on Orchard Road increased by an average of 12%, driven by aggressive asset valuations on corporate balance sheets. Concurrently, domestic retail sales volumes, adjusting for inflation, registered a net decline of 4%. This gap squeezed the operating margins of non-luxury retailers to less than 5%. The system attempted to correct this by increasing variable rent components tied to tenant turnover, inadvertently shifting the entire financial risk of the property market onto individual shop owners. When consumer spending permanently pivoted away from physical goods toward digital services, the entire cash flow architecture collapsed inward, exposing the vulnerability of structures that could not adapt. This collapse is highly visible inside Peace Center, a 1974 development on Selegie Road, where fragmented ownership acted as a systemic poison. Hundreds of individual proprietors held titles to isolated segments of the building. This legal structure meant that any major infrastructure modernization required an absolute financial consensus among competing interests. When the central air conditioning plant degraded, increasing building energy consumption by 35%, a deadlocked association refused to fund a replacement to protect their immediate cash positions. Without climate control, premium tenants departed, property values plummeted, and the building entered a terminal maintenance deficit. Centralized planning failed because the state could not legally compel private strata owners to reinvest capital they did not possess, turning a prime asset into an unusable concrete island. The maintenance deficit creates physical energy black holes across the urban landscape. Upper Serangoon Shopping Center demonstrates how passive maintenance accelerates structural death. The property relies on a vintage chiller system that drains electricity at twice the rate of a modern BCA Green Mark Platinum system. As vacancies rose past 40%, the remaining tenants faced a compounding increase in service charges to cover these fixed utility overheads. The physics of the building overrode the economics of retail. The cost to simply illuminate and cool the empty corridors exceeded the gross revenue generated by the shops inside. Attempts to cut costs by dimming lights and reducing operating hours only signaled to consumers that the space was non-viable, driving foot traffic down to zero. Where infrastructure does not fail technically, it fails spatially through vertical friction. Bugis Street features intense human density on its ground level, yet its upper floors have transformed into a silent desert. Architectural metrics reveal that foot traffic drops by more than 75% for every floor above the street level, if a building lacks an institutional anchor tenant. Without a global brand or a major department store on the third level to pull bodies upward, escalators become barriers rather than conduits. Small retailers on the upper decks, trapped by low revenues, stopped investing in visual merchandising, turning their shops into storage units. The upper levels became architectural dead weight, consuming real estate taxes while yielding zero commercial velocity. The crisis is not confined to legacy properties. The state's modern suburban planning model is experiencing systemic saturation. North Shore Plaza in Pungal was engineered to be a captive market community mall, tethered directly to high-density public housing. However, the development of the larger, technologically integrated Pungal Coast Mall, less than 2 kilometers away, triggered immediate spatial cannibalization. The local consumer base did not expand to match the doubling of commercial floor space. Instead, the fixed retail expenditure of the district divided. North Shore Plaza's revenue per square meter dropped below the sustainability threshold, forcing operators to slash rents by up to 30% to prevent a cascade of empty storefronts. This suburban contraction exposes the fatal vulnerability of the non-anchored retail model. Katong Plaza lacks the structural dimensions required to house modern institutional magnets like 2,000-square-meter hypermarkets or multi-screen cinemas. Without these primary gravity wells, the mall relies entirely on highly fragmented, destination-specific foot traffic, such as localized enrichment centers or niche service providers. When digital platforms seamlessly duplicated these services during the post-2020 transition, the mall lost its structural justification. Consumers no longer required physical proximity to access these functions, leaving the asset stranded without a demographic anchor to sustain basic maintenance operations. The state's attempts to mitigate this obsolescence through heritage conservation have produced stark economic paradoxes. The 2021 decision to conserve the brutalist Golden Mile complex on Beach Road exposed the extreme financial liability of preserving legacy concrete. Upgrading a 1970s structural shell to comply with 2026 fire safety codes, seismic standards, and modern electrical grids required capital expenditures that exceeded the cost of standard demolition and reconstruction. To make the project financially viable for private developers, the state granted an artificial increase in the building's gross floor area. This policy fix successfully saved the architectural shell, but injected thousands of square meters of premium office and niche retail space into a market already suffering from structural oversupply, shifting the vacancy crisis further down the economic chain. Even malls that achieved perfect market specialization are succumbing to systemic shifts. Queensway Shopping Center survived for decades by resisting luxury trends and consolidating dozens of independent discount sportswear retailers. This organic cluster created a high-velocity pricing environment that digital algorithms could not easily replicate. Yet, by 2026, global athletic brands pivoted to direct-to-consumer digital distribution networks, bypassing third-party physical retailers entirely. The physical inconvenience of navigating Queensway's cramped, obsolete layout outgrew the financial incentive of its discounted prices. Younger demographics completely decoupled consumer utility from the physical search process, rendering the specialized ecosystem obsolete. The destruction mechanism has now climbed to the apex of the system, targeting the ultra-premium tier of Orchard Road. Delphi Orchard, positioned on some of the most expensive land globally, faces structural elimination due to systemic underperformance relative to neighboring mega-complexes like Ion Orchard. In high-velocity financial environments, land cannot remain static. It must yield returns proportional to its compounding valuation. When a building's cash flow drops below the opportunity cost of the land it occupies, its liquidation becomes a mathematical certainty. The point of no return has been crossed. The system can no longer generate the organic human demand required to fill its immense physical volume. The real estate architecture has detached entirely from the human economy, mutating into a closed loop of debt servicing and asset restructuring, where shopping sanctuaries are no longer spaces for commerce, but liabilities waiting for the bulldozer. The financial fallout of this structural decoupling has breached the balance sheets of Singapore's institutional asset managers. By 2026, retail real estate investment trusts face an unprecedented re-rating. As debt servicing costs stabilized at higher baselines, property valuations based on projected rental growth decayed. Major funds executed aggressive capital restructuring, selling off underperforming secondary assets to protect their prime yields. This capital flight leaves mid-tier properties stranded without the liquidity required to sustain basic operations. The numbers are explicit. While luxury hospitality assets report high revenue due to an influx of global capital, the broader commercial retail sector faces a net capital contraction that threatens its systemic viability. The state's macroeconomic strategy has shifted toward an enclave model. Singapore has attracted over 1,400 family offices, turning the city-state into a vault for global private wealth. Yet, this capital influx has created a deep systemic distortion. The hyperwealthy do not consume mass-market retail or frequent traditional suburban shopping centers. Their capital flows into private banking channels, high-end art, and ultra-luxury residential properties. This creates an economic paradox where nominal wealth figures surge while domestic commercial infrastructure starves. The tax revenue once generated by a high-velocity retail model is fading, replaced by volatile transaction stamp duties on luxury assets. A model that relies on unstable global capital flows rather than a resilient domestic consumer base, the systemic transition systematically erases public and community geography. When an older space like J Cube or Tanglin Shopping Center undergoes en-bloc redevelopment, the physical destruction of the concrete accompanies the liquidation of local economic networks. Small, family-owned enterprises cannot afford the premium rents demanded by new mixed-use developments. They migrate to the extreme geographic periphery or dissolve entirely. The city reconfigures its physical form into distinct vertical layers, highly secure, premium residential towers for global capital at the top, and automated digital logistics networks at the bottom. The mid-tier consumer has been reduced to a digital node interacting with e-commerce platforms from public housing estates. The government deployed the Orchard Road Strategic Development Incentive Scheme, offering a 20% increase in plot ratio to developers who consolidate and redevelop older properties. However, this intervention contains a fatal structural flaw. It requires joint submissions from adjacent, separate land plots. In a landscape dominated by fragmented ownership, coordinating multi-party redevelopments has resulted in administrative paralysis. While state planners design pristine underground pedestrian networks and automated green corridors on paper, the physical reality on the ground remains frozen by legal deadlocks and high construction costs. The policy tools designed to rejuvenate the boulevard move too slowly to counteract the velocity of market obsolescence. The ultimate price of this systemic failure falls directly upon the domestic workforce. Retail trade traditionally employed over 150,000 workers in Singapore, acting as a critical buffer for low to mid-skilled labor. As physical storefronts close or convert to unstaffed digital showrooms, this employment pool faces immediate contraction. The system's attempt to retrain these aging workers for high-tech logistics or digital finance runs into immediate structural mismatches. The labor market polarizes rapidly, leaving a displaced demographic stuck in low-wage gig roles, while global talent occupies the newly built Grade A office towers. This human displacement is the direct consequence of an economic model that prioritizes the optimization of land value over the preservation of social utility. Private equity syndicates and vulture funds look to profit from this crisis. They do not enter the market to revitalize retail commerce or preserve architectural heritage. Their strategy relies on a calculated liquidation thesis. Buy fragmented strata-titled properties at a deep discount, deploy intense legal pressure to force a collective sale, and flip the land asset to global developers for a capital gain. This speculative activity inflates land values even further, making it financially impossible for any genuine, low-margin community space to exist on the site. The market has transformed into a closed-loop extraction machine, converting public urban space into financialized capital banks that yield high investor dividends but zero community value. By tethering its urban model to global private wealth while allowing its domestic mass commercial infrastructure to decay, Singapore increases its exposure to external macroeconomic shocks. If global regulatory changes or geopolitical realignments restrict the flow of offshore capital, the city-state will be left with hyper-dense luxury towers that have no domestic market capable of sustaining them. The failure-proof system engineered over 5 decades has traded internal stability for extreme external dependence. The vibrant shopping crowds that once anchored Singapore's international brand are gone, replaced by pristine, silent architectural monuments. The trajectory of this transformation remains completely irreversible. The concrete structures being demolished today cannot be replaced by spaces of a similar scale or social accessibility. The compounding cost of land prevents any reversal of the financialization process. The failure of the retail model is a demonstration of structural completion. The system has reached its ultimate logical conclusion, where every square meter of land has been optimized to its maximum financial yield, leaving no physical room for the human community that built the city. Orchard Road's new reality presents a pristine, hyper-polished landscape where the lights are always on. But the human economic purpose has left the building. The grand shopping sanctuaries have completed their cycle, mutating from